Hello, everyone. All right, so after we just had two presentations, very informative, we're going to move on to the panel discussion. So I am Cecilia. I will be taking you through in the next 40 minutes or so to go through the navigating the evolving regulatory landscape together with our distinguished guest. And they are from legal and tax practitioners from the industry. Okay, so without further ado, I'd like to introduce Alfred. Please come on stage. Okay, so Alfred Chung is a tax director at Citic Capital Holdings Limited. So with a professional background in U.S. tax, Alfred currently focuses on cross-border structuring and tax planning for Citic Capital funds. Okay, thank you. All right, so James Gaydon, I know James for many years. Okay, so James is a seasoned partner at Walker's Corporate and Investment Funds Group. Now, James has huge amount of experience from the last 20 years advising investment funds industries, including private equity hedge funds managers on fund formation, structuring, acquisitions and disposals, and fund restructuring and fund financing. Okay. Now, last but not least is Ling. Okay, Joe has already introduced Ling, so I won't say any more. So inviting Ling back on stage. Great. All right, so let's kickstart our discussion today. Okay, so all right, so let's dive into the first questions about the tax implications. Now, tax implications for foreign investors when they're investing into multi-jurisdictions and also different structures. So what are the tax implications for foreign investors when they're making these investments, and what are the best practices that we want to address for them? So, okay, so here we go. Maybe, James, can I just invite you first? Since we're seeing lots of Cayman domiciled funds in our region, and I'm sure you must be speaking to lots of different, managers.
Sure, thanks, Cecilia. I say this as a humble Cayman lawyer and not a tax lawyer or a Hong Kong lawyer, so please bear with me, but it's the right question to ask. Every year we go out to our clients and we ask them a couple of questions about what they're doing in terms of their projects. And one of the two questions that we ask them is, where are you structuring and why? And what structure are you using and why? And it's no secret that in Asia, 92% of all of the private equity and hedge funds use Cayman Island structures. If you look globally, it's 78% ex-US on the hedge side and 69% on the PE side. So Cayman is the gold standard. The question then becomes, why? Why do managers choose these jurisdictions and these structures? And the top-ranking reason every single year that we ask this question is investor preference and investor familiarity, right? Investors like this structure and this domicile. The second reason they come up with is tax. Tax is incredibly important, and it's that when thinking about the driver behind structure and plugging tax into that, the real question is, do you get comfortable that the fund structure itself is not going to pay tax? And that can be achieved one of two ways. You either put it in a tax-neutral jurisdiction or you get an exemption. And the second question is, how do you give investors certainty that that is the outcome that you're going to generate? Right? Looking to the first bit first, right? Setting up in a tax-neutral jurisdiction is dead easy. You pick Cayman, you pick BVI, you pick a place where there is no income tax, tax on profits, tax on gains, or withholding taxes. If you do it in Cayman, in 30 seconds, I can tell you that for the cost of $1,900, you can get a certificate from the governor and cabinet that says for the next 20 to 50 years, you will never pay tax at the fund level. All right. You then go across to KPMG, hopefully, and you ask them, okay, I'm managed in Hong Kong. Is what these guys telling me correct? And they will tell you that you can employ the tried and tested method of making sure that that Cayman fund is not carrying on business through a fixed place of business in Hong Kong and doesn't have a permanent establishment here. It won't pay Hong Kong tax. And that can be managed basically by operational protocols. It's not that difficult, all right? So that's your first option. Your second option, and I'm going a little bit beyond my pay grade here, is you look for an exemption, all right? And this is where the water gets a bit muddy. So if you look at Hong Kong, for example, there is an exemption from tax for investment funds. It's called the Unified Tax Regime, right? And the way that you get this exemption is you say every year on the year, I'm only investing in qualifying transactions. Those investments are only in securities. There might be some incidental transactions that aren't qualifying transactions, but those are subject to a 5% limit on tradable receipts, and all of these things are defined, right? Which means every single year you have to pay someone to find out if every transaction you've done is qualifying. Was it in securities? Was it incidental? If it was incidental, was it within a 5% limit? Was it through a qualifying person? You guys give that advice for free, right? The point is, every year you have to ask these questions. Every year you have to go through this analysis. Every year you are giving your investors a level of uncertainty as to whether or not there is going to be tax or not, right? Exemptions sound really good when you say, hey, dude, have a tax exemption. It sounds good until you have to pay for it, until you don't know if you're getting it next year, right? So there is a real difference between being in a tax-neutral jurisdiction and being in a place where there is an exemption. And when I say tax-neutral jurisdiction, I do want to use a dirty word very quickly if I can, and that's the word tax haven. Tax haven, if you look on websites which list the top 10 tax havens in the world, you will see Cayman listed. You will also see Hong Kong listed and Singapore listed and BVI listed. None of those 4 places are tax havens, according to the OECD, which is the global peak body for tax compliance. The OECD defines tax haven as a place with low or no income tax that has no effective means of transparency or reporting of information, and has no economic substance requirements. Well, guess what? All of those 4 places have low or no tax, but all of those 4 places have FATCA requirements, have signed up to CRS, and have some form of economic substance. So none of them are tax havens. So when people say, oh, you're investing in a tax haven, say, no, I'm not in Panama. Thank you very much. You know, I'm using Cayman, I'm using Hong Kong, I'm using Singapore. Anyhow, getting back to it, there's a definite advantage of being in a tax-neutral jurisdiction over being in a place that offers an exemption, because it gives investors that level of certainty which they require. And for that reason, I think there is a preference, and there will continue to be a preference for using tax-neutral jurisdictions over places that rely on exemptions. The other thing to note is that exemptions don't even work for everything, right? If you're doing private credit, the unified tax regime doesn't work because private credit aren't securities. If you're doing crypto, doesn't work because most crypto isn't securities. If you're doing real estate, doesn't work. If you're doing long-short equity on the Hong Kong Stock Exchange, you're pretty much okay, but why take the risk? Why not just do what people have been doing for 20 years? Set up a Cayman vehicle, make sure that you're not carrying on business through a fixed place of business in Hong Kong, and know for sure, for free, for the rest of the fund's life that you're not going to be taxed.
Thank you, James. Well, I think that's a very good point. I always cannot reconcile why Cayman and Hong Kong to be on the grey list anyway. Thank you. All right, so Alfred, what about from a manager's perspective, looking at the tax implications for foreign investors investing throughout different regions and structures?
I'm going to say something very different from, I guess, James, from a user perspective,
Okay,
right?
go for it.
Because, I manage the fund's, tax and compliance, I guess, to make sure they don't pay extra tax that they don't need to pay. So I do agree with James that, why come to Hong Kong if Cayman, if something is not break, don't fix it, right? So yes, in that case, I do agree. And from a tax perspective, you don't want to make something, you go in and then you claim the exemption, because that claiming mechanism is an action, and you disclose your information from the back. So if it's not necessary, you don't want to go there. But the Big Four, I guess they do advertise, or maybe they side with the Hong Kong ILD, saying that the Hong Kong Unified Fund Exemption is good. But as James said, it's a good thing, but you have to claim it. But it is a last resort. what I can say is because from a tax perspective, the partnership can be taxed. If you have, I wouldn't say PE, permanent establishment, but it's if you carry on business in Hong Kong, the central management control in the past at least, that they could tax you. And if they tax you, then the LP pays, and same thing. Everybody is not happy. The manager is not happy. So the unified fund exemption is a good last resort, which if you manage it correctly, you don't need that, which using Cayman fund. But if at the end you have no other choices, then I guess unified fund exemption is a good, fallback.
Right, it's a catch.
It's a good fallback.
Right.
Yep. So I think everybody should be pragmatic and look at all options. Cayman fund is good, but Hong Kong fund, I guess the unified fund exemption is if you qualify, and it can get you out.
Yes.
Yep.
Yes.
Can I just ask one quick question? Cayman funds can apply to use the unified fund
Yeah,
exemption
you don't
as
need
well.
to be a Hong Kong fund.
So you can have the best of both worlds.
Yes. I'm not trying to advertise for Cayman or say Hong Kong is bad, but
I am, so
Yeah.
sorry.
Okay, thank you, Alfred and James. Now, Ling, coming from a U.S. angle, what is your thoughts on the tax implications?
Well, here's what I think we talk about foreign investors. Really, we're looking at the definition of what is really a foreign investor. Really, in my view, from U.S. tax perspective, it really is the non-U.S. taxpayer, right? So when you have a non-U.S. taxpayer, potentially, what is the U.S. tax angle? Really is if the underlying assets are the U.S. So underlying asset can be really the shareholder interest. If you're going to the public market to buy the IBM stock, what is the impact, right? You potentially get a U.S. source dividend, then you potentially have withholding issue. So you have to provide certain type of documentation. We call it withholding certificate to the prime broker, or to the fund, along with your subducts, and then to the prime broker, and then you subject to withholding. But that's a small concern because the money, before the money goes out to the border, you already been withheld. IRS could care less. You don't have to file a tax return with IRS to get that unless you think you're being over withheld. I think the major concern really is we call it effectively connected income. Really is if for whatever reason you go into a fund that invested into a U.S. operating partnerships, okay, and also potentially go into the U.S. real estate type of companies and real estate holding companies, then you have a major issue with that because you've been treated as indirectly conduct U.S. trade or business. So not only your income will be subject to withholding, your proceeds. So when you're selling the assets in the U.S., the real estate assets, selling the operating partnership interest in the U.S., your proceeds will be subject to 10% withholding. So under that circumstance, you could be at a loss situation, but when you get cash, you have 10%. And that's on the cash flow side. But I think on the other side, also you're going to have U.S. filing requirement. Once you have the U.S. ECI, you as a foreign investor, all of a sudden you find yourself in a position you have to file with IRS, which is not pleasant situation. I have to say, because for a lot of funds, we know the fund set up a foreign corporation as a blocker, so the blocker would take on the filing obligations, so the foreign investor doesn't have to. But under the circumstances where you accidentally step into the area that you directly been treated as having U.S. trade or business, that causing you filing requirements. So that have to be careful. So really is the question is for your funds, right? When you have a U.S. When you have a funds, potentially have U.S. Investments, potentially has no blockers in there. And the majority of your investors are foreign investors. The question become, as a fund, you have to ask the underlying portfolio companies as well, are you going to generate U.S. ECI without a blocker? If you do, and then I think you really have to think carefully about setting up your blockers to prevent ECI exposure, prevent the exposure to your foreign investor. I think that will become a major investor relationship issue.
Okay, thanks. Indeed, U.S. tax is really complicated, so that's why we need U.S. tax advisor. Now, okay, I do have a follow-on question for James. Now, you talked about Cayman, Hong Kong compare, right? Now, we hear a lot of Singapore VCCs. So can you share some insights on Singapore VCCs?
Sure. I mean, again, I'm not a Singapore lawyer, so I apologize. This is going to be extremely high level. From a tax perspective, there are equally tax exemptions for Singapore funds and Singapore managed funds that are, bear some similarities to the unified tax regime from a very high level. If you are a Singapore fund with a Singapore manager or an offshore fund with a Singapore manager, you can apply for certain exemptions, and they are largely the same. Meaning that the fund does not get subject to Singaporean tax. Where they are different in relation to VCCs is, firstly, the VCC, in order to qualify for the tax exemption, has to have expenditure onshore in Singapore of about 200,000 Singapore dollars per year, which an offshore fund doesn't have to. They both have to have Singapore managers, so that's fine. The Singapore VCC has to have a Singapore administrator, which is fine because Linnovate has a Singapore office that can provide that service too at very competitive rates. What else are the differences? Key difference is that as well as applying for the exemption, you have to apply to the MAS, the Monetary Authority, to be tax exempt. And if you're a Singapore VCC applying for the tax exemption, if you want to change or tweak your investment strategy, you have to ask permission. Now, I think we know that we're living in a world where investment strategies are changing and evolving fairly quickly, even now in response to geopolitical concerns, macroeconomic concerns, the war in Ukraine, et cetera, et cetera. If you have to ask mum and dad permission every time you want to trade something a bit different, it's a pain in the butt. Right, so there is a difference between the 13R exemption that applies for VCCs and the offshore exemption. I'm not going to say which is better. I think we know how I feel about this. In terms of the VCC itself, I actually quite like them. They're a really cool little thing. They're very much like a Cayman SPC. In fact, if you download the constituent documents that are a sample for the VCC, you'll find that they are very closely based on the precedent SPC articles of association published by a good Cayman law firm that I won't name. So from a corporate perspective, these things work really well, and they're using corporate mechanics that are very well tested. Here's the difference, and this is an important one. We're all in the investment management community, so we all understand the importance of track record. All right. Track record is important for investors looking at a fund vehicle coming in. When they look at investment risk, it's equally important looking at two other risks that investors don't want to have to look at, and that's jurisdiction risk and structure risk. All right. If you've got two things that are otherwise equal, an SPC and a VCC, and one of them has 3 decades of jurisprudence behind it, judgments at the Privy Council, English common law that goes back 400 years that tells you how this thing is going to be judged, that tells you how people in litigation are going to be able to predict their outcomes. Would you go with that, where you've got predictability, certainty, 400 years of precedent, or are you going to go with something that's brand new, that no one's ever litigated about, that you don't know how the courts are going to assess, you don't know what precedent they're going to, well, they don't have precedent to look at, they can't. When the metal meets the meat, and a few of us in this room with grey hair have seen this before because we survived the GFC, we've seen funds get litigated, we have seen shareholders and limited partners go to war with GPs. Bad things happen. If bad things are going to happen, I'm going to go with the thing that's been tested before. I really like VCCs, and I think they do have a place, and I don't want to seem too biased. If you're in Singapore investing into India and you want to take advantage of the double tax agreement between Singapore and India, use a VCC. It's awesome. The Singapore-India double taxation agreement is much better, much newer than the one that has traditionally been used between Mauritius and India. Heaps better, heaps newer, OECD model, really good, go for it. But if you are trying to raise US money, and let me be clear, one of the other things that we survey our clients on is, who are your investors and where are they? The most important demographic of investors in Asia for Asian funds is still US money, followed by Hong Kong institutional money, followed by European and sovereign wealth money. If you're looking for sovereign wealth money, European money, US money, I can tell you they're not going to look at a VCC. That jurisdictional risk and structural risk is going to be too high for them to be able to get past. Great if you're doing something domestic. HKLPFs, fantastic for Hong Kong family offices. If you're doing a family office in Hong Kong, use one, talk to Sarah. But if you're looking at US money, You have to go with the product that the US investors are going to be comfortable with, and it's kind of a list of one.
Right. Thank you, James. Now, I guess in searching of the appropriate structure for your fund, you really need to think about tax and also what James has just mentioned, because tax and structure really interlink to each other. So, so you have the advisors, legal and tax practitioners in the room. So yes, please reach out to them. All right, so let's move on to our next question. It's looking at the challenges. Now, the challenges from the investment manager and in terms of compliance, how do we ensure compliance with the multi-regulatory regimes, given that we are looking into different structures, into different regions? So, all right, so maybe I start off with Alfred.
Sure. I guess the most important thing is talk to professionals like Linnovate, Walkers, and KPMG. Information coming up so fast. Even if you're practicing like me, you cannot know everything. So only people in the market can, see what's coming and know what's good or bad, or at least they know. I hope they know. So I guess there's no perfect structuring. Compliance. Everything is moving so fast. We all know that OECD implemented a lot of compliance things. I don't even want to go into it, but FATCA, CRS, we all know about that, and the regulatory changes coming up. For tax perspective, what are you saying? Yeah. I guess we want to make sure that you don't have Hong Kong tax when you try to invest into something. You realize, again, using a SPV in Hong Kong, and maybe you invest into China. How do you minimize, I guess, the tax from both sides? The China side and the Hong Kong side. And then you don't want the money going out. Hong Kong has no withholding, so you don't want the money going out subject to more taxes, right? So that's how we, I guess, structure to look at. You utilize the best tools and the current atmosphere. We cannot foresee what's in the future, but at least we know what's now. So if your boss come back and say, "Why do you do that?" Well, at least now we can back it up. So I guess the most important thing is to consult with the professionals and know what's coming. And something may not be logical. I mean, compliance is never logical. They could be out of this world and they just want to do it. So you cannot have a logic sense and interpret tax. Tax is never logical. Yeah.
Okay, thank you, Alfred. Now, what about James? How about from your perspective, from operation?
I mean, I agree. I don't know about the not logical bit, but otherwise I completely agree with Alfred. Tax scares me. But the other thing that we hear over and over and over again, and Henry nailed it when he said that we're living in an increasingly regulated world and it's ever changing. And the place where we get complaints about the ever changing nature of regulation and the fact that it's incredibly complex is usually around AML now. And if you go back in time to when this wave of regulation sort of started post-GFC, you had FATCA come in and you had Volcker come in, and the response to this new set of regulation that was never there before was largely for managers to go, we have to recruit a huge internal compliance department. But the rate of change was so fast that you ended up with big compliance departments that did exactly what Alfred said, had to outsource anyhow because they couldn't keep up with the rate of change. The solution that we're seeing more regularly now, and I think it's the better one, and Alfred sort of implied this, you get one really good person internally and you lean on your experts, but you keep things streamlined and lean. You stick with what works and you stick with people who can make it work. So if your first fund was set up as a Japanese private equity fund as a local LPF, go that way. Rinse and repeat. Don't change it. There are lots of shiny new toys available, but stick with your knitting. Pick a good administrator straight up. pick good tax people straight up, pick a good auditor straight up, build relationships, scale those relationships so you have one point of contact, you know. And that's really important. And outsourcing is not a dirty word, right? In April this year, SEMA, our regulator, spat out a bunch of statements of guidance, one on outsourcing. And when we heard this was coming out, a few of us sort of went, oh my God, they're going to kill us. But what SEMA actually said in a statement of guidance is it expects fund managers to outsource material activities of its operations. Let me say that again. The regulator wants you to outsource. It expects you to outsource material bits of your thing because it wants managers to get it right, because it wants standards to be high. It's not saying, you know, go off, outsource everything. We don't want you to be responsible for anything. Go. It does say that you need to monitor the people you outsource to. You need to assess who you outsource to. You need to keep in touch with them and make sure they're doing the right job. But that's what you're doing anyhow. That's what fiduciaries in this line of work do. So I think I take this as a blessing, you know, Alfred calling it absolutely correctly. Outsource to the right people, keep a tight bunch of trusted advisors that you can use for your entire business going forward. And I think that's the way that you deal with the complexity and don't muck around with shiny new toys.
Thank you. That's our job to pick up the work that you want to outsource. Okay. Now, right. Now, okay, so we talked about the tax implication and also the compliance on the regulatory front. Now, let's look at the regulatory changes because in the past year, we actually have many legislation implemented. And let's look at how these regulatory changes have impact on the investors and investment managers. So may I start with Alfred again to talk about from the Hong Kong perspective?
I guess the most recent one would be the FSIE. It was effective this year,
Yes.
January 1st. And what that came from was from the European, again, the EU. And I guess they just want more compliance and they just want, you know, they reach very long, that their arm is very long. They want to make sure everyone reports and comply with what they think is right. So in the past, if everybody knows, I guess interest, dividends, dividend, capital gains, and royalties, which is the FSIE covered, mostly are tax-free in Hong Kong. And the FSIE, I guess they changed it, and all of a sudden they said, it changed pretty quickly also. You know, it came out last year and then it went into law because the EU threatened us saying that if you don't do it, we'll put you in grey list. So, so we went through the legislature and everything became law very fast. And January 1st it became law. And interest, dividends, capital gains, and royalties all of a sudden can be taxed in Hong Kong. And so obviously it's just like James said before. You need advisors to help you because if you are managing something that's you're not a tax background, it's difficult to I guess to manage. You don't have that one person like me, I guess, to tell the CFO or the boss what to do. Just on a high perspective, you guys probably know that you have to meet certain criteria to make sure that you get the exemption. Otherwise, in the past, dividends would not be taxed, but it would be taxed, and same as capital gains. We got ways to get out, but now if you don't meet the exemptions, you're taxed. So, and it's for exits or dividends that have been received in 2023. So if you guys are having something that came up, that income happened in 2023, you better find out how to get around it. So I guess that's one major one that I would talk about. FSIE.
Okay, thank you. That's a major one. That's a hot topic. All right. Okay. Looking at Cayman regulatory changes, tell us, James. Tell us about what you're seeing in terms of Cayman changes.
Yeah, the good news is that I think we've seen all the change that we're going to see for the immediate term. And the reason for that is exactly what Alfred said. The genesis of all of the changes that we've seen around substance, around AML, around CRS over the last 5, 6, 7 years have been driven by the damn Europeans. Right? It is all driven by the OECD, it's driven by BEPS, it's driven by the FATF reviews. Fortunately for us in Cayman, we adopted CRS and FATCA early. We implemented economic substance at the direction of the OECD in 2019. Job done. No more BEPS stuff for us. Thank you very much. And the FATF review, which is relevant to AML, has concluded. And I'm very happy to announce that as at last week, we ticked the box on 63 of 63 recommendations of the FATF. So we're going to come off the grey list. But it also means that there won't be any more AML changes for Cayman in the near future. Stop right there for a second, because that doesn't mean there aren't going to be AML changes that are relevant to this rule. If you click into the FATF website and look at our home jurisdiction of Hong Kong, you'll see that it's largely compliant with 25 recommendations, a little bit compliant with 11, and not really compliant with 4. So if the FATF holds Hong Kong up against the same measuring stick as it did Cayman, we can all expect that there will be some AML changes at home, in De Troppo, in IOSCO, probably in the LPF AML provisions that are embedded in the LPF ordinance. It's coming, all right? But it's okay. It's easy fix. The good thing for Hong Kong is you've got a sort of a roadmap. You can just copy and paste from what Cayman did and sort out the problem. The thing that I think is relevant in terms of the fact that Cayman has completed most of its changes, and this is where the good news kind of ends, is that the regulator has pivoted from implementation of new rules to investigating and enforcing the rules that it's put in place, right? Is that a scary thing? Investigations and audits are always scary. They're particularly scary when they're to do with AML, which is very, very complicated, and it comes with little criminal offences that people can go to jail for. I'm looking at anyone in the room who's a money laundering reporting officer. But, okay, here's the good news. CIMA have stated that their budget for investigation and enforcement is 65% dedicated to what are called CIBA registered persons. So that's managers and advisors, not funds. The remaining 35% of their enforcement budget has to be spread around banking, which has been a little bit busy lately, insurance, finance leasing, trust companies, which means that there's going to be very little enforcement budget for fund vehicles. So the only people who have to really worry about this are people who are Cayman advisors or Cayman managers. So what do you have to worry about? You have to worry about getting a letter from CIMA that says, hey, we're doing an investigation of you for money laundering purposes. Okay, how do you respond? The letter will say, turn over a ton of documents, turn over your policies and procedures, and turn over all of your corporate records which show that you have implemented your policies and procedures, and then wait for a phone call. This is not a problem if you've got good policies and procedures and you've got good corporate records, which means it's not a problem if you've outsourced your AML policies and procedures to Linnovate and you've hired good money laundering reporting officers who are independent of portfolio management within your shop. If you've done that, if you've kept good records, you can basically take the phone call from CIMA and be on your merry way. There's nothing to worry about. If you get nervous, if you need support, call your lawyers, call us. We've got a regulatory team who basically does nothing but help people with supporting them through this process of investigations. But it is coming if you have a Cayman advisor or manager. Apart from that, there's not really any news, if I'm honest.
Okay. Recently, I read an article about CIMA. It's proposing for the fund managers, Sybil, and also the registered person, that they need to confirm or notify CIMA that they had the internal audit. It's something called like statement of guidance or something.
Yeah, absolutely right. I mean, there's two elements to this. That's one of the questions that they will ask in the context of investigation, but they've also sent out, and you may have seen it, a lovely Excel spreadsheet of 750 questions that are part of the audit survey for all managers and advisors. If you've got it, you probably should open that email. If you look at it and you think, I'm not answering 750 questions, guess what? You're right. You're not answering 750 questions. For most people, around 100 of those questions are going to be relevant to you. Of those, most of them are going to be easy to answer. And if they're not easy to answer, again, give us a call. I'll put you in touch with Colin and Jason and Bonnie. And in the space of 45 minutes, they can sort out the entire thing. 750 questions in 45 minutes is pretty straightforward. I mean, that's the thing with regulators when they're kind of new to the enforcement space. They come on really hot and heavy. They come on wanting to look very tough. Oh, I'm going to ask a million questions because I'm a tough regulator. They'll sort it out in time. You know, give them a little bit of time to get used to the enforcement part of their role, and it'll be easier for you, it'll be easier for them.
Okay, thank you. Now, in conscious of time, let's move over to the ESG question. Now, ESG has been a hot topic as well. Now, how are you seeing ESG affecting the investment funds space?
Yeah, it's a super hot topic, but it's more hot in terms of enthusiasm for the space than it is in terms of regulation, at least in the private fund space. You know, Cayman does not have any rules or regulations in relation to ESG specifically. Hong Kong doesn't have any rules or laws in relation to ESG of private funds specifically. There are rules in relation to disclosure for listed companies and retail and authorised funds, but they don't apply in the hedge fund and the private equity fund space. There are circulars that talk about how people are going to disclose things in their PPMs that apply, but in terms of actual rules, actual laws, not a lot of activity going on there. If you take a step back and you look a bit more globally, what we do see, and this is particularly out of our Cayman office, which faces the US and faces Europe, is that ESG has become much more front and centre. It's become almost a marketing tool. It's not just a dirty little secret that people hide as I promise to do the right thing in the back of a side letter with a particular pension fund investor. It's something that people are paying real money to consultants to say, hey, how can I make my prospectus look as though I am a good corporate citizen conscious of the zeitgeist of ESG. Is Asia doing that? Not so much. We're seeing it more in the Japan-facing space than we are out of Hong Kong, China, Singapore, but we'll catch up. For as long as this is a marketing tool and is attracting the right money, and for as long as institutional investors want to see it, and that's a bit of a question mark in my head given what's happening in certain states in America, we'll see ESG start to come through. And that's on the ES side. On the G side, the governance side, again, not a lot of movement, not a lot of rule changes. The governance framework that we see deployed in hedge funds and private equity funds industry-wide has remained pretty stable. Now, you may be thinking that you got a mail out a couple of weeks ago that said, oh, but SEMA released a new statement of guidance on corporate governance that we all have to comply with. Yes, it did. But all that was basically a reprint of a 2014 statement of governance that applied only to mutual funds, and they say, hey, guess what? Private funds are now included too. But there's no real substantive change. You know, if you have strong corporate governance, as I'm sure everybody in this room does, if you've got good directors who discharge their fiduciary obligations, you don't have a ton to worry about. Okay. But what I would say, and it's the point that Alfred and I have made over and over again, service providers matter, and I'm not going to say lawyers matter because they kind of don't after launch that much. If you've got your launch sorted out, the service providers that matter are your auditors and your administrators because they're running your day-to-day operations and they're going to be absolutely critical in relation to governance on a day-to-day basis. Have a good administrator, have good money laundering reporting officers, have good tax and audit guys, and you'll be fine.
Okay, great, thank you. Now, last question about this is an interesting question that we put on the agenda. It's about SVB. Since it's 4 months since SVB recent meltdown, so how are we seeing the banks are keeping up to support the funds industry in terms of the opening bank account and etc. So Sarah, yeah, you're here. So maybe first of all we start off with the panel. The speakers, anything that you're seeing in terms of like what are you seeing the banks are helping, supporting the industry?
I mean, frankly, it's a bit of a mess. You know, I don't think I'm not giving away any trade secrets here. The FCIB have said that, the FDIC has said that it is going to treat all of the depositors of SBB in Cayman as effectively unsecured creditors. So there is no protection for them and no money back for them at this point in time. Some of you might be aware that the Minister for Financial Services, Andre Ebanks from Cayman, was out here a few weeks ago. He met with a few of those depositors and a few managers, and he's assured us that he's in discussions with SEMA to try and sort something out. I don't know what that something is going to be. I don't know if that something is going to be anything. I've heard rumours on the street that some of the unsecured creditors, the depositors, are thinking of bringing a class action against the defunct SVB. That is a rumour, and there's no such thing as a concept of class action in Cayman. What they will probably do, if they do it, is get together and petition to start a court-ordered winding up of the bank. Now, why'd they do that? I don't really know. When I wind up companies, I like there to be assets that I can get paid out of. I just don't know what's at the end of the SVB rainbow. In terms of the support that the local banks have been giving to the depositors, it's been pretty cool, if I'm honest. On that weekend when all of this was falling apart and our phones started ringing saying, I've got $400,000 with SBB. This is where my working capital account is. I've got a fund financing facility with SVB. What do I do? The banks, some of the local banks in particular, you guys, DBS, some of the others were really good in helping grease the rails and open bank accounts at what is relatively the speed of light. For the last 3 years, all I've heard is people whine about, it takes me 3 months to open a bank account, 6 months to open a bank account. We were having SVB clients get new bank accounts open with local banks in as little as 3 days. It was brilliant. It just goes to show what people can do when they put their minds to it. And it was really nice to see people putting in an effort to help each other.
Okay. How about Alfred? Do you have anything to add on to the SVB?
I can only say from my experience, from my colleagues. I don't go about opening bank accounts, but we had some Cayman SVB and then some SVB US. And, for SVB US, we got the money back quite quickly. But then, where do you get those money? You don't have a bank account. So you have to quickly open a local bank account, right? Other than an SVB. So you go to Hong Kong or Singapore branch to open. So I guess they've been pretty helpful. If they don't know you now, they get to know you because you're a new client, and I guess it's a good way to build relationships to get the new money.
Okay, great, thank you.
We got a lot of requests to help them to fund to complete WA certificates, right? So we kind of joked about, hey, this is the opportunity for you to really complete a correct one at this point because WA expires in 3 years anyway. So this is what, yeah.
Okay, thank you, Ling. All right, so that will wrap up our panel discussion. So I would like to open up to the forum for the Q&A sessions. Now, does anyone from the audience have any questions that you would like to ask our speaker? Okay, I guess that's a no. So everything is cleared. All right, so in that case, that will bring us to the end of the session, and we can get some drinks next door at the Treasury Room. So once again, thank you very much for the wise counsel.